the education of a value investor. We also known for his for being the man who won with Monish Pravai won the privilege of dining with Warren Buffett. Very unique opportunity to have an open mic with Guy. Please have your question. Please set aside your questions. We will have a question and answer period at the end of the session, where you will be able, the selected parties will be able to ask Guy directly any questions they may have. Well, we are in a very interesting moment in financial history, very unique at the end of the COVID pandemic, with unique central banking conditions, and we are looking at a change between we're looking at a possible inflection point between value and growth. So which is never a better moment to hear from an expert his opinions on the matter and his journey through value. Guy, please take it on.
Muchas gracias, Sebastián.
Oh,
¿Puedes escucharme?
Te podemos escuchar.
Muy bien.
Very important to point out, he has an important link to Mexico, his wife.
Yo pienso que todo entienden español aquí. ¿Sí?
Well, we actually have more than 100 registered participants from 3 continents.
Ah, bueno.
The names I'm seeing right now are Mexican, so we can go in Spanish. We can go in Spanish. We can go in English.
So I will talk in English, but and I was planning to talk in English. And for those of you who don't understand Spanish, I'm just going to say a quick hello in Spanish. No es mi idioma madre, pero estoy muy orgulloso que tengo una esposa mexicana, una regia de Monterrey. Yo aprendí todo mi español en la familia, jamás o muy poco lo utilizo por los negocios. Solo esta presentación en Madrid, en el Valley School, pero estoy muy feliz de conocer todos ustedes. Y después que mi corta presentación, si quieren poner sus cuestiones en español, no me molesta. Puedo decir que yo veo aquí en Suiza, se pasa mucho que el alemán, el hombre que viene de suizo alemán habla en alemán, y la persona que viene de suizo francés habla en francés. Pero con eso, gracias de recibirme, y otra vez estoy muy orgulloso que una parte de mí es mexicano. Y con eso voy a pasar en inglés. Hello, everyone. It's a real pleasure to be with you. I would just tell you that even if you, and you should know that obviously my Spanish is perfectly fine for expressing myself in all sorts of, it's not like English. English is not just my mother tongue, it's more than my mother tongue. But it's a really, I think in a globalizing world, it never hurts to begin a conversation, even if you only know one word in the other person's language. It's a kind thing to do. And that goes for whether you're in Russia or in Japan or in China or in Thailand or anywhere else, but very certainly when it comes to a Spanish-speaking country, which is one of the largest language groups in the world. So, Sebastian, what I'm going to do is I don't have a prepared presentation. The positive of that is that I will give you a set of a few thoughts that are in my mind right now. So what you will have from me is extraordinarily current. And I think that I should take about 20 to 25 minutes to do that. And then hopefully that has triggered some questions or ideas or thoughts in some or other member of the audience, and then we can make it interactive. So that's what I'm going to do. I will just tell you that if you're able to, so Frank Ruiz will just put his face into the video. If you want to add your face to the video, I think it makes the whole event more fun because I can see your reactions. either happy or unhappy. So I appreciate if you're doing that. So I'll just go into the few points that I've got prepared for you, which actually come from my annual letter that I just finished writing and will be published in the next week or two. I think that where I come from in the investing world, it's been extraordinarily difficult for me to see that so much of what I learned, so I've been investing for about a quarter of a century, and so much of what I have learned over the last 25 years can be trashed because the business world has changed so dramatically and business models have changed so dramatically. So that's the bad news for me. But the very, very good news for you is that it means that somebody who's just starting out, the relative disadvantage in terms of knowledge and experience is far lower than it ought to be, given the relative amount of hours spent in this world. And so just to give you one example of many of that, I have recently joined Clubhouse, which is the most interesting and exciting social network that has come around for a long time. And I joined a conversation in which somebody called William Andreasjan, who is half my age, I suspect, recently minted MBA from USC McMaster, I think is the name of the business school, was sharing insights with just Q&A. It was an Ask Me Anything. And I was taking notes. I was learning from him. But just to give you a sense, so there's somebody called Bill Gurley, and he's a venture capitalist. He knows more about the way the business is going to unfold right now than any of the people who stood in the pantheon of value investors. For me, for example, I haven't read a lot of Bill Gurley's stuff, but I need to read a lot more of it. Or, for example, there's another venture capitalist called James Currier. He has a website, I think it's nfx.com, Network Effects. He's written some fantastic essays on network effects. And in order to understand a new world in which data once, or a piece of intellectual property that exists on the internet, once it's been created, can be very, very rapidly and almost costlessly replicated. There's some very, very different economics in place to the economics that I spent the vast majority of my investment career participating in. So, and it's true that I have the basic economics models in my head, but it's still, it's a whole different world to apply those economic models, not just as an intellectual exercise, but to actually go and buy some companies' shares based on those insights. So, you know, you can, I'm sure there's plenty that we can dive into to discuss there. It's, you know, software is eating the world. That was true 20 years ago. That came from Andreessen Horowitz, and it's even more true today. So that's my first point to you. Then I'll give you a second point that, so I have a global network of friends and investors, and just I've been around for long enough already. When I was an undergraduate student, there were people from all over the world there. So at the beginning of last year, I was in touch with some friends, some French friends who were living in Shanghai, and they were talking about their lockdown and the fact that they couldn't leave their homes. And, you know, we were in touch, we were on a common WhatsApp group, and they were taking photographs of deserted streets. I had, you know, I think my point to you is that I had every opportunity to have early warning of what was happening, that there was a very significant event taking place, a far bigger event taking place than anything that I'd seen in my lifetime. I completely discarded that evidence and did not act upon it. And even when I saw that the virus was coming to Europe, and the first way in which I saw it was that there were people that we were starting to get statistics from Italy that things were not very, very good there. And I remember watching a video on YouTube in a mathematics website called 3 Black 1 Blue, where there finally the penny dropped for me as to the nature of the exponential growth of the virus. My first action and my only action was to warn my parents and my wife's parents that they could be vulnerable. I still did not see or understand the enormous impact that this virus would have into my portfolio, for example. And even as I started to understand that it was going to have an economic impact, there's no way that I could have foreseen the differential impact, for example, that every single retail outlet pretty much across the planet was going to be impacted. What is my point to you is that I think that there are many people who think that maybe somebody in my shoes has better foresight or better insight or can act better. And that's not the case, or at least that's not the case for me. And what I've recently wrote to my investors is that I don't think it's the case for anyone, actually. And so in my view, what I am trying to do as an investor is to set myself up in such a way that in spite of me making those huge errors of judgment, if you like, my portfolio still survives and thrives. And the question that I ask in my annual letter is, how do you set up a portfolio that will survive in spite of the unexpected, the unknown, and the unknowable? You know, the future event that will impact our investment portfolios is not going to be what we expect. It'll be something completely unexpected. And the good news is that there was nothing in my portfolio that was permanently impacted, but that is because because of the investment decisions that I took. So that's just another thought that I thought was an interesting one and worth sharing with you. I have many, but the idea, you know, if you think of the role, my role, or what I'm trying to do for my investors, I'm not trying to show them a Ferrari sports car that can drive very, very fast, because the Ferrari sports car, Formula One car, can only drive on a track with a fantastic team and the right tires and the right petrol, and everything has to be just right. I'm trying to drive a Jeep. That's what I'm trying to build, something where if it gets stuck in the middle of the jungle, you know, I can somehow fix it with the available equipment and that it will continue to move forward no matter what. So I then want to address a third idea, which is, again, something that is an extraordinary, for me, development in the world. It might not be for everyone here, but is an extraordinary development for me, which is that and it comes from studying Elon Musk and Tesla and SpaceX. And it's that, you know, many of you, some of you will be aware of this, some of you won't. I very seriously studied Philip Morris, the largest manufacturer of tobacco products, when I was a recently minted MBA. And my view was that so long as they're making a legal product, and the people who buy it are aware of the risks, then who are we to tell the people who buy it not to buy it? And who are we to tell Philip Morris that they can't do it, or they shouldn't do it, or that they're a bad business, or that one shouldn't invest with them? I felt so, and I kind of, the way I approached it was to say, you know, the governments and others set the rules, and I operate within those rules, and I invest in other businesses that operate within those rules. And we saw what happened to Philip Morris. Philip Morris got made effectively in the United States to pay for the cost of all the people that it was giving cancer to. And we live in a world today where there is far less patience, if any at all, for companies that aren't actually helping to improve our economic system. And what I could not understand about Tesla is that I kind of said, well, how will they ever make it through, given all the reasons why the incumbents are going to do well? And what I didn't see or understand was that Tesla has got an extraordinary mission. Even if the economics don't work today, they're going to find ways to reshape the economics to work for them tomorrow. And the reason why they stand a chance, at least, of reshaping those economics is that they have a moral mission. They have a mission that enjoys broad support across the population of the planet. And therefore, when they go to the German government or the Chinese government and say, we're going to build a plant here, and you damn well going to help us to do it, and they will look at every which way possible, from subsidies to tax holidays to changing the rules of the game for their competitors such that there's space for them in the market. That was something that I didn't see or understand until recently. And so I guess that I think that I understood it implicitly, but I didn't see it as clearly as I do now. And I want to share with you what I see is sustainable investing. And so that, you know, I think that I make a distinction between sustainable investing as being virtue signaling. And it's not that I'm think it's a bad thing, but there are plenty of people, and mainly very large funds, and you know, quasi people like BlackRock and those very large asset managers who know that if they can label themselves as sustainable, they will receive very large amounts of money from people who will not invest with them if they're, quote, not sustainable. And there are also organizations that will analyze or claim to analyze the activities of a corporation based on ESG measures, tick some boxes and not tick other boxes, and come out with some kind of score or evaluation as to whether this is a sustainable corporation or not. You know, there's the concept of something called a B Corp, which is an interesting organization based, I believe, out of London, that will give you a stamp of approval if you're doing the right things. So there's nothing wrong with that, but I do think that a lot of it can come under the rubric of virtue signaling and effectively a way of marketing yourself. But then there's another understanding of sustainable investing, which is that, you know, all good investing is intelligent investing, and looking to see what the mission of a corporation is, how it interacts with all its stakeholders. Is this a company that seeks to leave society in a better place or in a worse place after, you know, during its life cycle? And the realization that if a company in any one of its stakeholder groups is doing damage or leaving people unhappy, sooner or later the shareholders may come back and impose, sooner or later society may come back and impose costs on the corporation that may have to be borne by the shareholders. So I can't tell you if gun manufacturers in the United States will ever be made liable for the people that their guns kill unnecessarily, but it certainly factors into my analysis and probably means that I would not choose to invest in a gun manufacturer. And so that simple idea, is this company building the civilization or is it not building the civilization, I think is a worthwhile and interesting one. And I have many other points that I can go to, but I want to go to one last one, which I may actually get a very negative reaction from this group, an unhappy reaction, but I think it's an important one. But I'll illustrate the point by addressing a different country to Mexico, but then we'll move on to Mexico. And just to be clear, I'm gonna start with Mexico, and Mexican food, and then I'm going to go to Greece and talk about some other countries, and then we're going to come back to Mexico, if that's okay with you. And please don't hate me at the end of this. And the reason why I start with Mexican food, so we visited Monterrey last year, and I was, I have some favorite restaurants in Monterrey. Actually, one, I know some of you guys are from Monterrey. It's kind of a dive called Acabe. It was not such great food, but there's another restaurant called Gran San Carlos, which I just love. And my wife prepares Mexican food, not all the time, but we're extraordinarily happy when we get a shipment of tortillas from Mexico, which have been properly made, because it's hard to find here in Europe. In any case, and we hosted a lunch for friends in Monterrey, and we had a mariachi band there, and it was just awesome. There's no mariachi bands here. I could go on, and I would just tell you that my whole family, and when I say that, I include my parents and my sister and my family in Israel, have benefited from the infusion of a Mexican into our family. So I love Mexico, but we're going to put that aside for a second. Now let's talk about Greece. So some of the smartest people I know in the world are Greeks. The CEO of Pfizer is Greek. He's and I've seen an interview with him. He's done an extraordinary job for Pfizer, as well as for the countries that he's distributing his vaccine into. He's a really bright guy. There are many others. Many others in the United States, but outside of the United States as well. Greece as a country is not a great place to run a business or to start a business. And the exact reasons for that, we can get into a debate as to why. But I think that it's really important to make a clear distinction between, first of all, the people who can be extraordinarily bright and the environment that they're in. And so then let's just talk about countries' geographies for a second. So I want to compare two countries, the United States and Russia, briefly. Both vast continents, both very rich in natural resources. United States, though, geographically has border with two countries, both of them which are non-belligerent. Mexico, Canada never, Mexico since the last, 150 years, and two seas on either side. It has an extraordinary population in the country. The natural resources that exist inside the country are amazing. From the Mississippi River, which is one of the largest navigable rivers in the world, to the Great Plains, which are one of the best food basins in the world. Seeded with a legal and political system that worked. So in the case of the United States, you have a country that, in spite of enormous problems, is a very functional place and where capitalism works extraordinarily well. By contrast, Russia is, has no seaports in the wintertime, except now perhaps you could say it does via territory that they regained into the Baltic Sea. They have a vast expanse of wasteland that extends 9 or 11 time zones. I don't remember exactly how many. They have more borders with more countries than any other country on the planet. They have it's like, when you think of the Chinese, the Iranians, the Europeans, the number of countries goes on. And the strategic depth of the country is vast. So once somebody is in control of Russia, it's very hard to dislodge them. What am I trying to say? Russia does not contain the conditions within it for a liberal, democratic, peace-loving, law-abiding, non-kleptocratic government. The history of Russia has been that, whether it was under the communists or under the regime that we have now, or under the Tsars, it has been a dysfunctional place, and a place where there are some very, very rich people, and a lot of people don't have a great life. And by contrast, we have other countries. And what my point to you is that a lot of this comes down to simply geography. It's just geography. And sometimes geography changes. So, the economic technology changes the benefits of being in different places. So at one point in history, it was good to be a country on the Mediterranean. The vast majority of trade happened on the Mediterranean Sea. And then after a while, a country that was an island off Europe, the United Kingdom or Britain or England, had far better access to the sea and had a geographic advantage actually over Europe. But geographic advantages and disadvantages don't change all that much. And my point to this group, and it's a point that I make to my Mexican family, is that Mexico's position, just geographically and geopolitically, is not the worst for sure. I think that Russia is way, way worse. But it's also, and this is the painful bit, not the best. And very unfortunately for Mexico, there is enormous dysfunction that is created by the proximity to the United States. Enormous, enormous dysfunction. I would tell you that, so my father grew up in Israel, my mother grew up in South Africa. When it comes to the vast majority of my wealth and the wealth of my fund's shareholders, I would not sleep well at night if I did not know that 70 or 80% of it is reliant on the political and economic systems of a short list of about 7 countries. And you all will be, so that 7 countries includes the United States and Canada. It includes Switzerland and the United Kingdom. And then, New Zealand and Australia, and probably, some of the countries in Western Europe, maybe some of the Scandinavian countries. That's more or less the list. But just to be clear, South Africa, where I was born, is not on that list. Israel, where half my family comes from, and I feel a close tie, is not on that list. And I don't think that, so if you're smart, and I suspect that everybody on this call is smart, we don't have to be patriots to the country of our origin. And what I say about Mexico is that to my family is that I think that Mexico has extraordinarily good chances of getting to a very, very, very good place. And that's great. But I make a clear distinction between places that I love to visit and have family, like Israel and Mexico for me, and places where I want the bulk of my wealth. And if you plan on becoming rich and secure, I think that's important analysis and something to take into account. So with that, that's 4 points. I have other points that I can go to, but I will dive into, it's kind of fun to hear where you are. There's some of you probably left the call and others are throwing up all over your computers or something. So I will stop and see what the reaction is.
Well, you certainly started an interesting debate. Obviously, my prepared questions go out the door. So let's, you raised a very interesting point regarding geoeconomics, right? I mean, in fact, some of the points you raised on Russia is very similar to the long telegram all the way from the Cold War. The start of the Cold War and Mayhem's theory of the island state. Very important. Geography obligates. Now, it's the one thing we can't change. But something that is true, you mentioned that Sweden, for example, would be a good repository of wealth. Norway. These countries 150 years ago were very poor and somewhat unstable. It's not in the case of Mexico in particular. Mexico used to be for 300 years was a very rich and prosperous country. The source of the dollar sign is the Mexican peso. The proximity to the United States, could that not be a source of of stability, a stabilizing source in the future, basically as being under the sphere of influence, of economic influence of the U.S.
Absolutely, and it's what I saw when I first went to Monterey, in 1,000 different ways. In fact, I love Monterey's attitude and the people in Monterey. You meet people in Monterey from all parts of Mexico, and Monterey has this can-do attitude, and people are open, and that goes down all the way to the street names. And then what happened to the whole neighborhood, where, and I don't understand, none of us understand exactly how or why it happened, but Monterey was when you thought of a drug-related violence, it happened elsewhere. It didn't happen in Monterey. And I had a theory that there was enough wealth there. I had various theories. Then suddenly Monterey became extraordinarily violent, so there's no question in my mind that the economically Mexico will grow at high rates, and that's partly as a result of the proximity to the United States. It's also the result of the number of people in Mexico who've been educated in the United States, who have close relationships in the United States, and bring the spirit of modernity into Mexico, and they make it live. Not just, the spirit of modernity exists in Mexico's laws and rules, but they slowly make it live in the actual interactions between people. But nobody can guarantee that you're not going to get the kind of thing that happened in Monterey, where suddenly violence, drug-related violence, went through the roof. There was a period of, it started around the time that we came to Switzerland, around 10 years ago. Daily, my wife would see reports of just unspeakable things happening to her friends. And just to give one personal story, the boyfriend of my wife's sister was murdered in cold blood for doing nothing. And I've seen it, it was shocking to me, because this is Monterey. It's where a lot of rich people live. This is in Garza Garcia, and many people know it. And, the murder wasn't reported in the newspapers because journalists don't want to report that kind of thing, because who knows what kind of retribution will come to them. And my point is, if both from a perspective of personal security for me, but also from a perspective of investing, you don't know exactly how well your rights will be protected in a country like Mexico, I think, relative to some other countries. And then when it comes to, you're absolutely right. I mean, I don't know the history of Sweden that well, although I think I'd probably include Sweden in that list of 7 or 8 countries. Also, Switzerland 150 years ago was a very, very poor place. And I don't know how well wealth could be protected in Switzerland. So I think that, so I'm not saying that these things are for all time. And I think that a lot of us, and some people still today, had concerns about what will happen to the United States. Some people were concerned about whether there was a coup taking place earlier this year. How stable is the political system in the United States? I think that those are very, very important considerations. And you're absolutely right to question Sweden and Switzerland and the United States. One should think about those things. If the United States becomes an unstable place where people's saved wealth cannot be protected, then we're in big trouble. I think the United States is still one of the best places in that regard. And my point to the group here is one of the great benefits of being somebody who wants to or does invest in publicly traded securities is that the world can be your oyster, and you can think of any company on the planet as being a potential investee. I know German people who have more than half of their portfolio in the United States through investments in stock market investments. And what I urge this group to do, especially if you are wealthy or you become wealthy, is to think in that global way. Don't don't think of, don't think Mexico first. Actually, think globally. Take care of your own, and in a certain way, what I would tell you is if you're a Mexican and you're thinking globally and investing globally, that is one of the best things you can do for Mexico, rather than have this sense of I have to invest in Mexican companies. I have not spent a lot of time studying Mexican companies, but the few that I have studied are quite opaque. And it's really, really good, I think, for anyone who's sitting here with me to address management when you get the chance to address management. I mean, when I was dating my wife, there was TV Azteca, and there was a Grupo Televisa, which I took a look at. I'm seeing some smiles. And Grupo Televisa, who would not want to invest in Grupo Televisa, which basically owns everything Spanish? I mean, not quite, but pretty much. They're a combination of. And then you look at the corporate governance, and you realize that you're investing alongside a family that kind of consider themselves to be a bit like the royal family of the United Kingdom. And the thing to do with people like that, and there's a Cemex, as best I can tell, is the governance is far better. But what they need to hear, I would argue, from my limited perspective, from Mexican analysts and investors, is to look at them and say, why should I invest with you when you're so intransparent? When I have within 2 hours flying or less, I have so many wonderful companies that hold themselves to a higher standard. I think that's really important and valuable. It'll benefit them. So, yeah, and my point is, so I'm pushing myself a little bit, because obviously I'm not really Mexican, but to the extent I'm married to a Mexican, maybe you'll forgive me for saying it. We can be, just because we have a Mexican identity, just because you have a Mexican identity, does not mean you're not a global citizen. And that means learn from the best wherever the hell it is. And if it's in Mexico, that's great. When it comes to certain kinds of food, it's certainly Mexico. I mean, my God, have you seen what they do across the border to guacamole? What they call guacamole? It's a disaster. But let's do the same, and that's a kind of a way of elevating Mexico. It's one of the most important things that I think that we can do as me as a quote Mexican, you as actual Mexicans. By the way, I'm seeing all these questions on the side. That Sebastian, should we go to them or?
I think that yes, and I'd actually like to bring up Frank Reese, because I think this one works well with what you're stating. Resilience. Frank, you have a question on Berkshire and the all-terrain Jeep. Do you want to speak up, or I'll just read it for you? So
okay. Hi. How are you? Thank you for your presentation. I like it very much, and it's a pleasure. I have read the book, and it's wonderful, all the insights that you gave us through the years. And my question is that, if you believe that Berkshire Hathaway is that Jeep all-terrain vehicle that you use as an
so Frank, it's interesting because as you say it, I want you to know that when I was writing my letter and building an all-terrain vehicle, I wasn't thinking of Berkshire Hathaway. I was thinking of the fund that I run. But when I stop and think about it, I realize that it's exactly what Warren Buffett has been building for the longest time. So, in a certain way, he's trying to build a vehicle in which you don't have to be smart anymore in order for it to be successful. And he tries not to get into businesses where you have to be super smart. He wants businesses, and there are some there's a company that is publicly traded that I also own shares in called Moody's. It's a credit rating agency. God bless the CEO's soul, but believe me, if I was the CEO, I believe I could do the same job as he can do, and I would look freaking brilliant like he does. And I'd say the same for Coca-Cola, for example, is a great example. By contrast, if you want to run SpaceX, you have to actually be a genius. And so that's just one example of building a resilient business. To drive a Formula One sports car, you probably need to be a pretty extraordinary driver. To drive a Jeep, you don't have to be. And so I think that, yes, I think that that's a criterion that Warren Buffett takes into account. He doesn't want to be in too many businesses where you need a genius. It's also worth saying, if you need a genius to run it, then you could be very vulnerable to if you lose your CEO, you could be very vulnerable to the negotiations for a new CEO, because there's kind of a smaller number of people who can do that job. So there are many kind of like smaller decisions or aspects of a decision as to whether to invest in something or not, which kind of go to that idea of resilience. And I don't think it's easy to kind of like in one or two sentences or even in a book or two to kind of define what that resilience is. But I think it's not hard to agree that some things are more resilient than others. Land, if you there's an investment that Berkshire made in the company's called Pilot, and they own gas stations specialized for truckers. And you kind of ask, well, what's the point of that? And the world is electrifying anyway. And you realize that, the national highway grid in the United States is an investment that isn't going anywhere. Nobody's building a new set of roads alongside the existing set of roads. And even when you have these kind of spurs, a road going off to a gas station, it's not easy, especially around towns, to build a new one. So if you already own one and own the real estate around that, there are many things you can do with that. You can build a hotel, you can do battery charging stations, you can sell food. There are 1,000 different reasons why that land is likely to be valuable over time. And again, that's something that, Frank, you and I could run together. We'd have no problem, even though we haven't yet met, and we could be sitting somewhere very happy on a Greek island and still run it reasonably well because the asset takes care of itself. And I think that when we're in a period like this, those kinds of considerations, they leave people's minds, because what everybody wants to talk about is how they've made so much money in Bitcoin, or how Spotify is just this incredible business, or why Roku is this incredible business. But then there'll be other times when people, not out of a choice of Spotify and Roku and Snowflake, probably 2 out of those businesses will succeed, but one of them will not, especially at this valuation. Whereas in the stable of Berkshire Hathaway businesses, probably 9 out of 10 of those businesses succeed. So in a period like now, Berkshire Hathaway looks unsexy, or tends to look unsexy, but that's okay. So another point that I had here that I'll bring up now is, well, I'm going to bring up 2 points. One is that if you plan, this is maybe not relevant to people who are just graduating business school, but if you plan on being successful over a long period of time, you need to accept that regularly, every year or two, there'll be a new group of people who are more successful than you appear to be. And so, if the line that I'm on, I hope this is kind of something like that, every year there'll be people who are doing this, and maybe they do this and they continue, they blast past, or maybe they do this and they decline, but one should not allow those phenomena to distract us from I don't want to allow those phenomena to distract me from what I'm doing. So there is nothing, I think that the only point I'm trying to make is that there is nothing wrong with having a strategy for life and investing that we know gets us to a good place, and seeing other people getting to other places that look pretty good faster, So there was a point that, again, I'm going to potentially make myself unpopular by saying this, but it is a really important point to keep in mind. So I guess this is a group of people, some of you will be business school graduates and recent CFA graduates, whereas I think that there are probably some people here who are investing for themselves, you know, what I say I'm doing, I may only be talking about a part of what I'm doing. So it's very important to see somebody's decisions in the context of their whole portfolio, first of all, not just a part of it. So imagine that I have, you know, I don't know, $100 in real estate, and I'm talking about investing $10 of mine. And, you know, I kind of know that I can go back to my $100 of real estate, even if the $10 goes to zero, I might invest one way. And obviously, if I don't have any real estate, and let's say all of my wealth is invested in equities, I might see things differently. Every person is got their risk profile is very, very dependent on the exact circumstances in which they're in. And so it's really, really important, as you hear me talk and other people talk, is either ask directly or build out that picture so that if somebody's, you know, talking about how they made so much money in XYZ opportunity or Bitcoin or what have you, you know, did they do that with 1% of their portfolio? Did they do it with 100%? Did they want to risk 100%? That all of that context is often missing as we evaluate people. And then the point that I wanted to make to the analysts in the room is that you have if your plan is to go to work for some kind of investor, then you have an extraordinary challenge, because there is what makes sense to do as a principal, and then there's what makes sense to do as an agent or as an analyst. So if you're an analyst and you're advising a fund or an investor, or you're writing research reports, you're helping them with their research task, you have a very, very different set of constraints and of challenges that you have to overcome. And I think that if I was, first of all, I have to say that when I was in the business of looking for a job as an investment analyst, I did not succeed. It was, you know, we can talk about the reasons why. It's not a job that I would envy right now, but if anybody on this call is planning on doing that, I would just urge you to, you know, you have to take everything that, for example, I'm saying and set it aside and be aware of it, but also realize that you're going to be working for somebody who, you know, may themselves have their own constraints. They may have marketing constraints. They may have constraints on keeping investors happy. They may have their own biases about what they think works and what doesn't. And so your job is, you know, 1,000 times harder, if you like. And I think that it's just made a little bit easier if you make yourself brutally aware of the conflicts that exist in the thing that you're trying to do, and be aware of it and accept those compromises. Back to you, Sebastian.
Wonderful. We're drinking from the fire hose. So we're getting questions, a whole stream of questions. Very interesting. Particularly on reconciling value investing and technology. So I think let's start with Rodrigo, and then Regina. I think both of your questions were first on the line on this line. If you can start, Rodrigo.
Sure. Thank you, Sebastian. Thank you, Guy, for your time and insights. I mean, basically, my question is, I mean, given your recent interest in technology stocks, which again, they're not at odds with value necessarily, I'm just curious how your approach to value has evolved in the past few years, and whether we should kind of think about value in a different way, and perhaps not be too dogmatic sometimes when we talk about value and investing in that space.
Yeah, and you know, you ask such a great question, and I have many people who I've met at the Berkshire meeting, friends of mine who are closer to your age than to my age, who are all over Roku, Spotify, you know, I mentioned those already, but other Snowflake, Salesforce. So you know, we all know that at the end of the day, the value of the business is based on the cash that one can take out of the business. And that we know that is the gravity that it all comes down to at the end of the day. And then you have these businesses where winner takes all. So if you spend fast enough and hard enough and get to dominate your market, you will because the network effects, if you're in a market where there's powerful network effects. So there's a story that James Currier tells about somebody who was a board member of, or maybe James Currier was the board member of eBay. And Jeff Bezos comes to him and says, look, we're going to start auctions on Amazon and we're going to destroy eBay. So, if you want to drop your directorship, because you're a friend and it's just not going to be fun for eBay to deal with us as a competitor. And, apparently eBay still today is extraordinarily clunky in their technology. They don't use Amazon Web Services there. But Amazon failed to do that. That is the nature, that when you have a dominant network effect, it's extraordinarily powerful. And so if you're in an industry where that dominant network effect is present, it makes an enormous amount of sense to spend every last dollar that you have and to be extraordinarily loss-making. And so the company will look extraordinarily unprofitable. It will look like you're paying a very high multiple. I think that what I would say is that there are many companies, unicorns, that are going after those network effects. And some of them will achieve those network effects, but some of them won't. And the ones that won't will be spectacular failures and people will lose a lot of money. I think that my approach to it is that I can't figure out which one's going to have those, which one's worth paying up for and which one isn't. I spent a lot of time with somebody who's a significant shareholder, he has a lot of his portfolio in Salesforce, and he walked me through his model of why he's invested in it and why actually it's cheap and all of those things, using some of these kind of like lifetime value of a customer and what is the cost of churn and all of those good things. And he came to the conclusion after that he could invest. I came to the conclusion after that even with all of that, I couldn't invest. But I think that this is where kind of looking at somebody in the context of their portfolio is perhaps valuable. So, so the way I kind of try to think of my portfolio is, I think of myself as a caveman, and there's the very dangerous, nasty jungle out there that's got saber-toothed tigers and it's got mosquitoes and it's got snakes and all sorts of bad shit. But it also has woolly mammoths, and if I kill one of those, life is really, really good. But I can't get that unless I go far away from my cave. And then, I have my beautiful safe cave where I can grow some plants nearby and they'll feed me sort of, and maybe I can kill one or two small animals nearby. If I need to create a balance in my portfolio between being inside the cave or close to the entrance of the cave, which are these things that I know that if the storm comes or if the wild animals come, I can go inside the cave and be safe. And, in my case, that might include Berkshire Hathaway and this Swiss food company, Nestle. And then I have things where I go far outside the cave. And I think that, yes, I've started buying some technology companies, but for me, that's going way outside of my cave, and I might have my head handed to me. And so I need a balance between those two things. So that's the only way that I've been able to deal with not being able to answer your question, because you asked a very good question and I am unable to answer it. I don't think anybody else is either. I think that, there is what is really extraordinary is, so there's a book coming out, somebody who helped me to write my book is a guy called William Green, and he has a book called Richer, Wiser, Happier. It's coming out in a couple of months. And in that book, he describes somebody called Nick Sleep. And Nick Sleep, about 8 years ago, 9 years ago, decided to own 3 shares. He owned Berkshire Hathaway, Costco, and Amazon. And I think he started off with an equal weighting in all 3. And because Amazon did what it did, he now has 90% of his portfolio in Amazon and 10% in Berkshire Hathaway. But to be able to make such a huge commitment to a company that's kind of far outside the cave, or at least would have mean for me far outside the cave, that's something extraordinary. And is, exactly how he did that is going to be interesting. In the book, there'll be a debate about him. His name is Nick Sleep. In my portfolio, I put 3 or 4% of my portfolio into this company, BYD. And BYD is now, last time I looked, 15% of the portfolio. So, I went outside the cave and brought back a mammoth, and now it's a big part of my wealth, if you like. So I guess that can happen if you, I don't know, a certain amount of luck and skill, I guess. There was somewhere where somebody asked me about position sizing. And so actually that goes to position sizing. I think that, for me, based on my risk tolerance, if you like, putting 5% of the portfolio into a particular company is a great number, because 5% is large enough that if your company goes up 5x, that's a significant contribution to the portfolio. But if you have it go down by 50% or more, you've lost 2.5%. And that is not devastating. So I really like this position size of 5%. But I think that, so I think that if I was a guy looking for a job as an analyst, I would try and become a real expert in these new business models, in the snowflakes of the world, and try to understand, try to get advanced insight before the market into whether this is actually going to turn out to be worth the valuation or not. And do that. I mean, something else that I would tell you that is, again, very interesting and kind of pisses me off, but is good news for anybody who's younger than I am, is that all of the financial analysis is kind of out the window. Because if I go and look at any of these companies' balance sheets, and if I look at their income statements, it's not going to tell me anything. So I have to discover new ways to look at and understand what is going on in those businesses. And I still haven't fully figured that out, actually. So, but so life is tough, but you heard it from me, or you have already heard it from Charlie Munger many times. This is not supposed to be easy. I'll just share with you one other thing. And I just want you all to know that when people like Rodrigo nod and smile, it really helps me. So thank you for doing that. But this is not a thought that it's a thought that I've expressed elsewhere. But so again, I've thought about it hard in a world which is changing so much, and in which I wrote this to my investors. I don't know if I can say that I bring any particular advantage to the table other than the fact that I've been doing it for a while. But in terms of, I'm one guy sitting in a room in front of a computer, and every single individual here is one person sitting in a room in front of a computer. So yeah, I have a network of friends that I talk to, but look at what happened to me with my friends in Shanghai that should have given me an advanced warning, because for one reason or another, it didn't help me one bit. But I do think that, an idea that has just is a really powerful idea for me is, first of all, you have Charlie Munger, who said many times, the best way to be successful or to become successful is to deserve that success. So, in my weekly calls I have a team of about 6-7 people, a question that I ask, either explicitly ask it or I have it in my head, is what are we doing? What am I doing to deserve the success that I hope that I will be granted by, if the random world works out in a positive way? And to wake up, that's something that we can actually have an influence on. And so, so there's a guy who wanted to attend my Value X conference, and I shouldn't. So I realized that there are certain minorities that were not represented at Value X, and I decided that I should have certain minorities. So I've not met this person physically, but he's raising money for a business that he wants to buy in the United States with the help of partners. And I just went and I did my very best, because I'd researched, it's in the construction industry and construction materials. I'd done some research in construction materials, and I reached out to those people with his permission. And I said, look, you remember I was in touch with you. We had a due diligence conversation. Somebody that I care about, that's what I said, somebody that I care about is raising money for a deal. Would you be willing to speak to him? And if it's of interest, would you be willing to invest? So I did the ask for him. I emailed 20 people, 4 replied. I put them in touch with him. I have no idea what will happen. I did that out of the simple desire to try and make good things happen around me, out of the simple desire that if I do that consistently over a lifetime, and 1 in 5 of people like that raise money and succeed with their deals, they'll remember me somewhere positively. And that will end up being, in one way or another, the universe will reward me for it, either because I will get a new investor who came recommended from him, or because I'll get a better insight into an investment. So I think that, one of the things that I'm doing, and one of the things that everybody here can do, and to the extent that you're younger than me, you have a huge advantage, is start investing in that goodwill network, if you like. Nick Sleep has written about Costco and about Amazon, and what he says about them is that they're kind of, by offering everyday low prices, by giving really good deals to their customers, they've got an asset, which is their customer goodwill. Customers wake up and they're excited to go shopping at Costco, and they want to give Costco their business because they, and I realized that perhaps the only competitive advantage that I can develop for myself is that people wake up and they kind of want to find a way to help Guy Spier because he's tried to help them in a genuine way sometime in the past. And, that is for me just about the only thing that I feel like is a consistently good thing to do. And here's, I guess, a point to you guys. We talked about, is Berkshire Hathaway a resilient business? And if you have a resilient business, what you actually want is, you want it to be able to be such that you don't have to be particularly smart to run the business, and it'll still do well. And I know that there are many highly intelligent people on this call, but wouldn't it be great to use your intelligence in such a way that in 20 years' time, you wake up and you don't even have to be intelligent? I spend a lot of time, I grew up partly in the UK, and I like studying the royal family as a business. So, you want to have a business such that when you have a son who's an idiot, you're still doing fine, and I don't want to accuse any member of the British royal family of being an idiot, but if you think about it for a second, that is success. Success is being able to survive idiots in your family, or idiot managers, if you like. And, I want to be in a situation where if I lose my intelligence in 20 years' time, maybe people will come and say, well, we wanted to invest with you. We know you've lost your intelligence, but we're just really grateful to you. So we're going to invest with you anyway. That would be a mark of success in a certain way. So, but building that moat is something that I think, that personal moat, each of us should be a bit like an Amazon or a Costco, I think is something that is extraordinarily exciting and will be very, very rewarding because it's on a daily basis creating the conditions for our future success. How am I doing, Sebastian? Oh, there we go. Somebody wrote Nick Sleep letters. Yes, very, very good. Good to see them there. And
you have a fan there with Anoop who's showing us links to your references. So I think Regina might want another go at you for technology stocks. Immediately afterwards, let's go to Anton, because it ties up with the idea of how do you construct a portfolio and if machine learning, it makes sense. So Regina, do you think Guy has answered your question, or do you want to go dive a little deeper? Lost Regina. I think you're up.
Who's up?
Anton Morgan, he's asking, what are your thoughts on implementing machine learning to run value fund?
You know, Bloomberg now has a function called bquant, and you can go into bquant and you can, if you're a Python programmer, you can access the full Bloomberg data set, which is far bigger actually than what is available on the Bloomberg monitor. And they have all sorts of data that one can use to try and write programs to access the data, to analyze it, to put up charts, to give you buy signals. So I just spent last week for 3 or 4 hours on the phone or on a video call with them to try and understand it. So I cannot program Python, but I have done a course on artificial intelligence, an introduction to like artificial intelligence and machine learning on edX or on Coursera. So I understand a little bit. And I think that I'm blown away by how neural networks and other kinds of machine learning are increasingly able to simulate what we thought only human brains can do. And that is just extraordinary. And I will continue to look at what the world throws up for me and see if I can use it in such way, in some way or other. I think that I fear that when it comes to me and my particular setup, it'll be a bit like the Warren Buffett story of the department store and the elevator and the escalators, in that, you know, in order to get an advantage, I have to have something that somebody else doesn't have. And if somebody else has access to the same data and the same machine learning tools as I do, then I may not get an advantage. So I think that it's quite likely. So who was it that I spoke to? I spoke to a guy who'd worked at a quant fund in London, and it seems that they use various different kinds of quantitative methods, machine learning included, very successfully in terms of short-term trading. And by the way, as I asked this guy was kind of curious to talk to me because of my book. And I said, look, just because we've spent time together, would you be willing to share with me more than I can get on the internet as to what you're actually doing to make money? And what he said was, he said, look, if I share that with you, I'll be breaking confidence with the other engineers at the firm that I work. And this stuff is kind of special knowledge that is shared around. And in return for, it's kind of a small group of people who know each other and understand each other and are willing to trade insights in very specific circumstances for specific reasons that they get an advantage as well. And so, and the reason why he was coming to me was that he said, look, each time you find one of these inefficiencies through using some form of computing power, there's a limited amount of capital that you can put into it. So you can't put billions of dollars. You can maybe put tens of millions of dollars into it as a trader. And then eventually that advantage goes away. So that's a long way of saying we're in a strange new world and I don't know the definitive answer. And I'm certainly not going to say it's not possible. I think that it's most likely that that kind of stuff will grant advantages to short-term traders, which is not the part of the market that I'm operating in. And I keep an open mind, and I try to look and to learn. And if anybody wants to approach me with material on that, I would say that one of my big insights that I took away from the course that I did was that, in self-driving cars, which is, I don't have the numbers in terms of data, the size of the data set, but there is an enormous data set, enormous. And they are worried, as I understand it, that the data set is not big enough. Even if you had the computing power, you don't have enough data to train the self-driving systems in order to make them work reliably. And the two big constraints that you have with any kind of machine learning is the data set on which you train your machine, and then computing power. And the computer engineers have to make tough choices. Even if you have enough data, it's not very hard. I was blown away. It's not hard to define a problem in such a way that you need infinite computing power to solve it. And what the guy did, I hope, this doesn't bore somebody who's a computer engineer, but you have a Facebook network of only 1,000 people, and you want to ask a computer to examine, so each person is connected to every other person. So 1,000 people all know each other. And now you want a computer to check the nature of the relationship. So if a human is a node, their relationship to another node is called an edge. And now you want to examine the quality of each one of those edges. And you could, just that simple analysis could take an infinite amount of compute, or practically an infinite amount of computing power. So when I come to trying to use machine learning to do fundamental analysis, so the idea that I had, and forgive me, because I'm diving down a bit of a rabbit hole here, but it's fun for me. I said, what if we could have a machine analyze every single public statement and filing of every company using neural networks to come up with predictions as to how those companies will perform over time. And what I realized very quickly is, first of all, the data set in that case is way smaller than the data set from self-driving cars. And at the same time, the computing power that you need is just through the roof. That's a long way of saying that I don't think that machine learning is going to have an impact at the end of the market where I'm operating, but it certainly already has had an impact on the very, very short millisecond by millisecond end of the market. It's a fun question. It's a really fun question. I wish I could, yeah, but I don't think I have not found a practical use for it. And if somebody does come up with one, please tell me,
Thank you. I'm sorry for not replying before. That really answers what I wanted to. That really sums up my question, because I think I see the same that you see. It's for short-term trading. That's why I was thinking, can this help into value investing, into long-term investing? But as you said, data is not as available. If you try to take on data from different financial statements, everything's going to be different. So you'll have a lot of issues into training a machine learning model to do that. But do you think this could become the way into which maybe in the future we can find out those black boxes that we see in the financial statements that you mentioned, that sometimes now a financial statement doesn't tell you anything, but maybe with machine learning we can discover those parts?
Yeah, and think of this, Anton. Is it Anton who was speaking? Did I get that?
Yeah.
So think of this. There's an author whose name I should remember, but I don't, who's talked about how she believes that the way the letter to investors by the CEO of a company is written, there's tells in the letter as to whether this is a shareholder-oriented management or not, whether they're good capital allocators, all of those good things. Imagine that we could unleash a machine onto all the manager letters as well as the 10Ks and Qs of the company. And maybe it's just a simple thing. Maybe it's something that we could put together in an afternoon, in which we're just saying, we realize that if a management is using a certain set of words then the company is far more likely to be a good capital allocator or not. Or maybe it's not that hard to say, to do an analysis of the words used in 10K reports for companies that have been high performers and for companies that have been not high performers. And maybe there's a certain constellation of words that are more likely to appear, and you can use that as a screening mechanism. So that might be work that we could do today. It's work that I would need a computer. I'd need somebody who's a data specialist in order to help me to do it. And I don't have the resources internally to do it. So, there might be stuff around the corner, and just because it's not available now doesn't mean it might not be available in a year's time or in 2 years' time. And by the way, if anybody can find a low-cost way to do that project with me, I'd probably be interested in hearing from you. But I would just tell you, so that is machine learning and programming machines to do stuff, and it appeals certainly to an engineering mindset. But imagine now that, don't imagine, something that I think is far more realistic for me is, so in the intelligence communities, they talk about machine or signal intelligence and human intelligence. And those are kind of two. So signal intelligence is everything you can gather from radio waves and examining people's internet traffic and all of those things. And apparently kind of, intelligence departments, the CIA or the whichever it is, DARPA, and there's different versions of the same agency around the world. They divide themselves. And the signal intelligence side, which is effectively examining now today internet traffic, unencrypting it and seeing what's going on, is huge. And effectively, what you're talking about, Anton, is kind of signal intelligence, but not for defense purposes, but for investing purposes. And then there's a whole other area, which is not talked about as much, but was talked about a lot during the Cold War, which is human intelligence. And that's, our relationships with people, what people can tell us. And I think that it may be that a far more effective way to invest one's time, energy, and resources is in one's human intelligence networks. And maybe all of us should be thinking ourselves as mini CIAs, and we need to develop relationships with people across the planet, people in this room, our classmates, people we find on LinkedIn, and figure out what it is that we need to do with those people to maximize signal as opposed to noise, useful information coming from those people. And I think that if you asked me, I don't know the answer, but I tell you what, investing in one's human intelligence network is far more fun and interesting, I think, at the end of the day, than building software programs to analyze data sets. And I think will probably result in better payoffs. And just to give you a sense of how Warren Buffett does it, and Warren Buffett is an unbelievably intelligent guy, there's no question about that, but his intelligence is aided by an investment in his personal moat. So what is it that we can do that means that when something really worthwhile has come along in somebody else's desk, we get the first call? There may be some things that we can do. Now, first of all, we don't want to get stock tips from idiots, so that's, we have to kind of not screen those people out. But then, I think that one of the ways one does that is, first of all, to act as a good filter. So to look at the information that's coming, I should look at the information that's coming into me and not recommunicate gossip and things that I'm not sure of, but recommunicate things that I am sure of that are high quality. But then also to think about who I recommunicate that information to, in what order and in what way, in a way that is useful to them. And I think that probably if you do that over a lifetime, then good things can result. And, in a certain way, and forgive me, this is like, I don't know, this may be too off the deep end or something. We've all seen pictures of the brain, and we've all seen pictures of neurons. Maybe a good model for what each one of us in this room is trying to do is we're a neuron in a global brain. And as a neuron, we want to become a neuron that is well networked, that has great inbound and outbound communication. And so we're trying to get the best neurons to select us for outbound information. And we're trying to receive the best inbound information. So so that the quality of the kind of data that's passing through our hands is the highest quality possible data that's around. And that for me is a really, really interesting challenge that I think is probably I think most importantly, it leads to a high quality of life, but it might also lead to great returns and great wealth. But it certainly leads to better conversations and nicer people around you and more interesting people around you. So yeah, interesting thought. And it's a great question, Anton. And by the way, it may be tomorrow that we discover that machine learning is where it's at in a particular area of investing.
Sure. Thanks a lot for that.
Yeah, and what I also want to say is that I don't think I would have said that 2 years ago. And something else that I write in my letter that you'll really enjoy, or some of my Bitcoin fans, I don't have any Bitcoin friends, will really enjoy, is that I'm not saying Bitcoin doesn't end up at zero, but my assessment of the probability that Bitcoin ends up at zero is far lower today than it was 2 years ago. And, I'm not saying I don't want to make any bets on the price of Bitcoin, and I'm glad to be able to tell my investors and you that my future success does not depend on the price of Bitcoin going down, sideways, or up. But if you held a gun to my head and forced me to make a bet on where the price of Bitcoin will be and whether it'll ever be zero, I'm far more reluctant to bet that it will be zero now, which is kind of, I think, so what I'm trying to say is that I've become far more respectful of new technology, the increases in computing power. I used to sort of think that I could just ignore it. And now I realize I can't. I have to assume that somebody's working on something that's going to totally disrupt every single thing I understand today. And when we get those kinds of disruptions, it's just great for young people, It's a great advantage because all of my advantages go up in smoke. And so there's something very just and fair about that if you happen to be young and smart, And sorry, while I'm going on about this, I would urge everybody on this call, if you get the opportunity, try to travel to Silicon Valley, go specifically to University Avenue in Palo Alto. There's a cafe called the Blue Bottle Cafe. Just sit down and feel the vibe, and then walk down the street, walk past Palantir's office and various other people's offices, walk onto the campus of Stanford University, because those people, and you just have to feel it, you don't have to walk into a lecture or anything, they got the world in their sights. And I chose to move to Zurich. I'm glad I moved to Zurich. I'm grateful. I'm speaking to you from a mountain resort where I can go skiing on a daily basis. It's wonderful. But, another part of me would have liked to have moved to Silicon Valley, not because I want to become a venture capitalist, but because I would have many, many conversations with people who will help me to understand the extraordinary revolutions that are taking place in the world. Back to you, Sebastian.
So this is a great, so just two more questions, and we do have to jump on the panel. But I'm greatly enjoying letting you run with the questions, and I think the audience also. So Eduardo has a question pertaining to the impact of loose monetary policy and how you're seeing that. And afterwards, let's jump to Jose Treviño on the evolution of Graham-Dodd investing.
So sorry, who's got the low interest rate question? Now Sebastian's muted. Sebastian? Eduardo, do you want to ask the question?
Yeah.
Blast away. Great to have you here.
Yeah, thanks for the call. I don't know. Well, my question isn't about monetary policy, but it's more about the incentives of the surging the space industry around the world. We've seen this year SpaceX raise almost
Sorry,
6 billion.
Eduardo, it was Eduardo Cortina.
Right. Confusion, yes.
But why don't we include it? I feel like
let's do both.
Yeah. So you go Eduardo Miller, and then we'll do Eduardo, the other Eduardo, and then we'll go to, I don't remember his first name, but the last name was Trevino. Back to you, Eduardo.
Oh yeah, sorry for the confusion. But I would like to know well, we've seen this year something for outer space and recent trend for improving the world. And I would like to know, what incentives do you foresee for the surging space industry? Because well, there's actually not a business rather than satellites. And my other question is towards incentives on ESG investing, on companies that report their metrics and giving up profitability due to compliance on these metrics.
Yeah, so on space, I mean, you know, I am floored by Elon Musk. He's like, you know, he must be a Martian or something. He must not be a human being, because I mean, what your point is, okay, so we're going to launch some satellites in low Earth orbit, but what the hell are we going to do on Mars? You know, what the hell are we? But he finds a way. I mean, I've seen him. We can see him on YouTube. He says, "Look, I'm just not interested in doing something for the sake of making money. I'm interested in creating compelling futures for humanity." And somehow he manages to shape things around him in such a way that he can succeed and continue to do what he's doing at those two extraordinary companies. I mean, I think that my point, I think what the point that I would have to you, Eduardo, is that we don't have to be actors in the movie. So I am very grateful that Tesla exists. I'm very grateful that SpaceX exists. And I don't have to be an actor in that movie. It doesn't work for me to be an actor in that movie. I'm in the audience just watching the show, and that's okay. And I don't have any I mean, nobody's going to try and convince me to invest in those two businesses, but that's a perfectly legitimate place to be. And I just I could almost say that I'm proud to be a part of an economic system that allows for people like Elon Musk to do what he's doing. And what an incredible world we live in. But can I, you know, so and just to dive into a little bit more about me, you know, on my father's side, his parents came from wealthy, middle class, and even more wealthy families. You know, unfortunately, Hitler came along in Germany, and they had to run with not much more than the clothes on their back. And on my mother's side, it's a not dissimilar story around the British Industrial Revolution and then running away from apartheid South Africa. I kind of feel like my psychology is probably too conservative, but I kind of feel like just building a security for my family, that's enough, you know, and that's just my genetics, that's my psychology, that's, you know, to be secure in one of those safe countries that I talked about, and to continue to grow wealth is just great for me. And so Tesla does not, or SpaceX does not enable me to do that, but I don't have to have an opinion. You know, I can just watch and see it unfold and be grateful for the benefits that it delivers to humanity, if it delivers benefits. So, you know, and I urge you to take the same view, especially if you're an investor. And if you're an analyst, you don't have to have a view on everything. You know, you can just say, look, SpaceX, I don't know enough about it. I'm focused on, you know, home delivery of food, DoorDash and the like, or I'm focused on cloud computing or some other area. You're absolutely right when it comes to ESG. I think that there are a lot of costs that either governments are imposing on corporations, or they're self-imposed out of a desire to hit some higher score on an ESG front. To the extent that it's governments imposing costs, look, governments are going to impose costs left, right, and center. And it's kind of like the political system that decides what costs to impose. Different countries make different choices about whether they want to force companies to pay for healthcare or pay for maternity leave or pay for cleaning up the environment in some way. And it's a good reason why you want your corporation established in a jurisdiction which will allow the corporation to succeed. So you want a jurisdiction that understands that if you impose too many costs onto them, they may either fail or they may have to move to a different country in order to succeed. But so long as those costs are being imposed equally, so, you know, the United States wants to pay 18% of its GDP in healthcare costs. And if you can see that it's approximately borne by all corporations, or then so be it. To the extent that companies are taking on ESG goals for the benefit of being able to say that they've taken them on, but there's no real benefit to them or society, or the benefit is, you know, can be argued. I mean, we're getting into dicey territory for me, because on the one hand, this is not your funds as the board of directors or as the CEO. You're using shareholder funds to make decisions about lower profitability for the sake of perhaps vanity. But the law is that the board of directors has broad latitude in deciding what's in the best long-term interests of the corporation. And I think that the benefit to you, Eduardo, and to me is that we can do our own evaluation. And if we think that this company management has got some ridiculous goal that has got nothing to do with bettering the environment and has got nothing to do with shareholder value, and they're just doing it because they want to win some prize or get some recognition in a magazine, then we have the freedom not to invest, if you like. So, yeah, and you know, yeah. So so just to be clear, Sebastian, I'm not answering the question. I'm just giving, you know, my random thoughts on some very good questions, and I hope that adds to the insights.
Oh, absolutely. Picking your brain is a very unique opportunity, and the thought process that goes into it.
Yeah,
so,
wait, who said that? Sebastian? So Sebastian, yes. I just have a brief question for you. If that's the case, why can I never say a word at my family's dinner table? Nobody listens to me at my family's dinner table. I just want you to know that.
Nobody's a prophet in their own home.
Truer words were never said.
Let's, you know, we do have to transition into the panel, but, you know, and again, this is such a unique opportunity. I'm trying to run with it. So let's do Jose Trevino, and let's then go to our panelist, Eduardo Cortina, and take it from there also with Jose Segarra and Rodrigo Lopez. You know, I'll briefly introduce them at that point. But so let's, what are your thoughts on how the evolution of Graham-Dodd investing and margin of safety? Jose, you're on.
Thanks, Sebastian. I think, I mean, it's a little bit complex, I think. I was thinking about the question, but you start out with value investing from the origins of Graham-Dodd security analysis, and then as of recent, we had Howard Marks published his Something of Value memo, which somewhat contraposes value versus growth, and so it gets me thinking that what he's trying to say is that essentially value investing is no longer a statistical practice, and it is more like making qualitative estimates about the uncertain future, which by definition is uncertain. So I just wanted to hear your thoughts on that, whether you agreed, and if anything, how can we adjust to that, I guess, you know, transition?
You know, so thank you, Jose. And I'm angry because I want to live in a world where Graham-Dodd investing is all I needed to do. And I want to live in a world where I could just get away with that for my whole lifetime. I could be a Walter Schloss #2, and that would be fine. And that's not what God gave me, unfortunately. And I really do, in a certain way. I mean, you know, a lot of, you know, Elon Musk and Chamath Palihapitiya and various other people would frown on me, but you know, I would prefer to have an easy life. You know, Warren Buffett talks about the media industry, about television, and he says that he preferred it when it was 3 networks. You didn't have much choice about what to watch, but there were only 3 companies. It was an oligopoly of 3 companies. That's way better. And so the world is just, but the fact of the matter is that when Walter Schloss invested, there were real, you know, 50% of book values all around, even when he was doing it in more recent years. And now the probability that we buy one of those things and it isn't a value trap in one way or another is very, very low. So, you know, John Miljevic, who runs a wonderful investment community, the Manual of Ideas, and he has a colleague of his that does it in Spanish as well. He called Graham-Dodd investing, quote, lazy investing. And very unfortunately for us, lazy investing is even less likely to work in the future than it did in the past. And, you know, yeah, sorry, it sucks. I'm with you, but we have to accept it. And that doesn't mean we have to accept crazy valuations. That doesn't mean we have to accept that a company trading at 100 times revenues is a cheap company. But we have to, unfortunately, grow and adapt and update my approach. I have to update my approach to how I find value. And I would tell you that even in the last decade, a decade ago, I could go to the Philippines and find companies that I was happy to invest in and did well out of, and I'm not ready to do that anymore. And we didn't even start to talk about China and the problem that China poses for me, because it's a strange place. So I have a debate with Monish Pabrai. Monish Pabrai is becoming apparently famous in Turkey because he's got some quite large positions in Turkey that have done very, very well for him. And I just say straight, I say, I don't want to invest in a country that imprisons journalists. Somehow that doesn't work for me. It's not where I want to be. So then we ask China, you know, and China's, I hear what Charlie Munger has to say, but I also hear what the detractors from China have to say. And I don't know what to think about it. It's very scary to me that the Chinese have developed a system of capitalism that doesn't require human freedom. You can shut down human freedom to express and political opinion and still have a very, very successful economy. I kind of grew up thinking that that was not possible. The one came with the other, and it seems like it doesn't. And so I have to adjust to that in the world as well and figure out what to do with it. And, you know, and then I'm just going to come back to what Charlie Munger said, that nobody said it's going to be easy, Jose. Yeah.
Eduardo, so let's ask Guy about the interest rates, and also I think you can. Eduardo is the chairman of the Mexican Private Equity Association. He's also a partner at Colony Capital, and also obviously a CFA charter, proud CFA charter holder, and a great supporter of our association. Eduardo, you're on.
Thank you, Sebastian. Guy, sorry, this has been quite interesting. You know, the beginning of this conversation, you were discussing parallels between markets, you know, some emerging markets. And obviously, some of us have been following you for a while. Remember that in June 2020, you mentioned, you know, adjust your models, given that central banks had this unlimited power to keep printing, keep the economy going. But then, you know, you have commented in the past regarding these inflation tapeworm, if that's the right way to call it. So, you know, right now we're still in a low interest rate environment, even emerging markets. And continuing to Jose's Trevino's questions about, determining future cash flows is becoming more difficult this day, this levels of expected inflation, or identifying this GARP type of shares. And I guess we've all seen some element of speculative purchases of shares. And to complement that, people buying crypto, some of them claiming that it's a hedge to the very own existence of central banks. So when we started discussing this geopolitics, it became clear, us coming from emerging markets, looking at developed markets, there's a clear divide. You might call it ideology, different countries following different textbooks, but some economies printing more than others. And as investors from here, we wouldn't know what to expect from interest rates. And I wanted to ask this question just to compare, the parallels between developed and emerging markets, but also to transition into what we were really wanted to discuss here, the comparison between growth and tech. Sorry, and by growth I mean tech, but the growth versus value discussion that has been endless over the last years. So what would you be able to tell us, about these levels of interest rates and the money printing?
I think that one place that I think is probably really important to go to is that, emerging markets, and I haven't thought it through, but one can probably distinguish. You have to look at each emerging market on its own merits, and there will be some central banks in non-developed markets that are probably doing a really good job, way better than the developed markets, of controlling the money supply. And there may be all sorts of reasons for that. China is probably doing a much better job of controlling their money supply, and I haven't looked at Mexico. So that they are heterogeneous, no question about that. Just to talk about what the United States is doing, Eduardo, I have now met a couple of central bankers, and they're just like you and me, and they don't know any more than you and I know. Isn't that scary? So one of the amazing fictions about the financial markets and the people who run them is that we walk around thinking they know what they're doing. I promise you, you and I could run the central bank of the Federal Reserve as well as Janet Yellen is. It's just, they're humans like us. They don't have access to any more data. They sit in offices that are less nice than the one that you're sitting in, or even the one that I'm sitting in. Maybe that's not entirely true. The Bank of England's very beautiful. So I think that if you or I were sitting at the Federal Reserve or the Bank of England, we would have done exactly the same thing that those bankers were doing, even though, so it's like, I have no, we'd be saying, I have no clue where we're going. I have no clue how this is going to end, but we definitely have to do this right now. Because if we don't do it, it's going to be worse. So, and if I'm sitting in Mexico and I have investments in either the stock market or in private equity or in real estate, which I would imagine are to me, the three most important asset classes. Yeah, you're right. I look at the United States and I don't say this is a haven of security. And I don't know what my allocation is. It's certainly not 100% Mexico. And I think that is no less than 25% the United States. And then it depends again on personal circumstances and all sorts of other things, or 25% outside of Mexico. I think that, the answer that I've given to investors various times is that you want to be, especially now, in inflation protected assets. And what does that mean? For me, that means, there are plenty of things. I mean, the obvious one is credit card networks, where as inflation rises, you continue to take a percentage of the inflated value of transactions, and so you are protected from inflation there. And so there are some places where one can be protected, but you're right to take it into account. And in a certain way, if you're a government like the United States that has a huge welfare state, you are far more exposed to inflation than the government of a developing country, which has far less social payments to all sorts of people for all sorts of things. So, you know, when it comes to, I'd like to come back to you and ask you a question. So you're the head of the Private Equity Association of Mexico. I'm curious to know what kind of private equity your members are doing.
Well, we're doing all kinds, from infrastructure, real estate, credit, venture capital, and obviously growth equity buyout. But I guess the comment comes, you know, the point is some asset classes follow what is happening in the markets in the US. And obviously you see the prices of the same asset, but in a different region, they obviously tend to have different prices. But now that because they follow what the tech prices are doing in public markets, you know, the financial models seem to be following something completely different, while you see some other asset classes within the private market sector, you know, taking into account the margin of safety, taking into account expected yield, whereas you know, some other asset classes are really depending on, you know, total addressable market, and I'm sure you see how it follows. So, you know, an environment that rates go low, the models become really sensitive. You know, it just can be all over the place. That's why I'm saying you get to a position that if you say what the market size, you know, the total market of something is, and then you divide, or you actually add up all the assets that are addressing that market, you find that there's more companies, you know, the valuation of those companies even more than that market. So it kind of shows there's some speculation at some end, but it's really the quantum of the rates becoming too low that makes things difficult to.
Yeah, well, you know, and I think that sometimes, you know, I think that my experience has been, and this may be helpful to you, Eduardo, and to your members, is that you kind of, one states the question knowing that there's no good answer, but it's a relief to hear that the person who maybe ought to have an answer doesn't have an answer. And I don't have an answer for that at all. I think that, but here's something to think about that I think is maybe helpful. So one is to say, I don't have a good answer for you. We're in an unusual time where I can understand how, you know, the assets that look cheap aren't going anywhere. The assets that look really expensive are the ones that seem super sexy and exciting. Somehow one has to make sensible decisions inside of that. And so here's a North Star that I think is helpful. And, you know, so you're talking about debate of value versus growth, you know, so set that aside for a second. And so in Mexico, we still have enormous concentration of land ownership. And what I saw and experienced in Monterrey is that many, not all, but some of the people who owned large amounts of land in the past were able to use not just the wealth that the land created, but the power and influence that gave them to establish new businesses, breweries, cement, all of the steel, all of those things. And, you know, there's a book, and I'll write it, or somebody else can write it, by Hamilton Helmer, the seven, you know, I won't get the title right, the 7 sources of power in business. And so just set aside for a second this sort of this debate versus value and growth, and think of yourself as, you know, a knight in medieval Europe, and what you're looking for is power. You're looking for, well, I mean, we can actually use the word defensible moats, but you're looking to wake up in 20, 30 years' time and to discover that the investments that you made are at the center of things, are at the center of the action. They put you in the position that the landowners of Monterey were in 100 years ago. And what do those investments look like? And, you know, I think that it's obvious to me now, I wish it had been more obvious before, that owning data centers puts you into the center of things. So maybe that would be a situation where you're willing to accept a different valuation model because you just say, I have to own a piece of that. You know, I want to own, you know, it's if I own, or if my fund or my company owns quarter of the computing power for data centers in Mexico, that has to be valuable in the same way that if you owned land in downtown Monterey in the past, that would have been valuable. But it just provides, and again, this is, I did something, so I learned that real estate is very unequal. There's some kinds of real estate, you know, farms in the middle of nowhere that aren't worth very much and whose value isn't going to rise very much. But you can buy a piece of land on the edges of Garza Garcia, and given that the population is rising, that could end up being extraordinarily valuable. So I updated my personal valuation models for personal real estate. And, you know, 15 years ago, when we lived in New York, we bought a house in the country. It was a big, old, beautiful house in the middle of nowhere, and I thought it was really cheap. It was actually extraordinarily expensive because nobody wanted that big, old, beautiful house in the middle of nowhere. And more recently, I've bought real estate for my family, and I've appeared to have paid a very high price, but I've bought in the very, very center of things. And so maybe the right way to look at these high valuations is not to say, you know, well, there's some crazy valuation model going on and do I buy into it or not, but just to ask a very simple question: does my investment put me at the center of things in 10 years' time? And if it does, you know, then maybe it's worth paying up.
Great answer. Thank you.
Yeah, thank you. I feel honored that you'd asked me a question. I feel like I'm not worthy to tell the chairman of the Private Equity Association of Mexico anything that's wise, but to the extent that you think I've been helpful, I'm truly honored.
Well, that's the false modesty. Let me bring into the conversation our panelist, Rodrigo Lopez. So he's already asked the question, but you might know this or you might not. He runs manager selection and equity research for Kue Capital, and he's actually an investor of yours. Investor and big fan. Really, in my mind, one of the up and coming investors in Mexico, one of the shining new lights of Mexican investment management. And I think this is a good point to talk about manager selection and how it works in this moment of uncertainty regarding value and growth. And
thanks, Sebastian. Thank you. No, and before perhaps I answer the question, it's funny, to your point, Guy, on kind of like building personal goodwill. You obviously, you probably do not remember this at all, but when I was in business school in 2014, I participated in a stock pitch competition with a firm called Upgrade Capital. And I remember that the prize for this stock pitch competition was to present to you via, telephone or a video conference. And I was one of the winners. And I got to present to you via telephone. And I presented a Canadian oil miner and oil producer, I'm sorry. And that was kind of like the first contact that I had. And after that, I started to work for Kue Capital, and it turned out that Kue is also an LP of Aquamarine. So it's funny how these things, serendipitously just connect. And, happy to connect through this medium as well.
Yeah, well, thank you. And I hope I behaved well, Rodrigo. And I'm grateful for your investment, and I hope that you're a happy LP.
Absolutely, no, for sure. And to Sebastian's point, I mean, I think one of the things that we really like about Aquamarine and about yourself, guys, I think it's basically three things. And you know, our manager selection process is quite robust, and that we try to tie qualitative and quantitative aspects of the funds, especially if they're public equity funds. But perhaps to talk about our kind of like thought process with Aquamarine and yourself, I think the resilience you've had over 25 years has been, you know, definitely a plus in our books. And one of the reasons that we said, you know, Guy is very consistent. He knows where he's coming from. He knows where he wants to go to. And I think that's something very rare in the asset management industry and something that we value a lot. The other thing I think is also the alignment of interest with LPs, kind of like the traditional Buffett partnership that you have, and that, you know, the fact that there's the share classes that you don't charge management fee, but you kind of compensate with the performance fee, with a hurdle, I think very much aligned with LPs. And it's something that we really take into account when we're looking at a new manager. And then the other thing that we really like about Aquamarine is like the way you approach behavioral biases. I remember that, and one of the conversations we had was like you were one of the managers that were very heavy on checklists, and that was a way for you to kind of first be aware of your biases and then try to address them and not fall into the common pitfalls that we all do. So I think that speaks to your investment process, and again, one of the many reasons that we're happy investors. And yeah, so to your point, Sebastian, I think it's a combination of getting to know the portfolio manager of an asset manager, trying to answer the question of, you know, are they good at what they claim to be good? And I think this goes for both public equity as well as private, because at the end of the day, this ends up being more of a people business, as much as you can, you know, run the numbers and calculate the Sharpe ratios and Sortino ratios and everything. But yeah, I think it's a holistic process, and happy to speak more if it's necessary.
Thank you for those very kind words, Rodrigo. I feel honored. I just hope I live up to them in the future as much as I have up to now.
No, absolutely. Pleasure.
Rodrigo, are you prioritizing any particular aspect in manager selection in the current inflection? In the current situation, are you weighting any aspect of managers more than you used to?
Not really. I wouldn't say that it has changed. Our framework has changed in the past few years, especially due to COVID. I think it remains the same. Again, it's just a matter of making sure that the interests are aligned between the GP and the LP. You know, making sure. You know, in addition to the fees, there's also the kind of like the co-investment. You know, making sure that probably the PMs have a large portion of their personal assets in the fund, that they eat their own cooking. You know, making sure that they generate alpha, or try to address that question, because it's a very difficult question to answer. But yeah, I wouldn't say that it's changed. It's remained quite consistently, and you know, we've kind of honed it and improved it throughout the years and through the different experiences we've had. But I think these attributes and values will remain regardless of where the world ends up. So yeah.
If Sebastian, if it's okay for you, I'd like to ask Rodrigo a question. And
sure.
So, you know, if you stand up in any environment and say, "Oh, we invest in managers," you'll get like 80 resumes and fund presentations, and so I'm curious to know how you sort through the people that you might invest with, and how you deal with all the people. I mean, you know, on this call, you could get a lot of people who come to you now. And so how do you evaluate them? You know, in a certain way, I'll put myself into the shoes of somebody who'd like to get an investment from Q Capital. Right. What should they be doing?
I mean, I think the best way that you know, we evaluate or kind of learn from a new manager or an investment process is kind of like get to know the investment process in a deep manner. And the way we do that especially is through the investment letters. Like, you know, aside perhaps from the resume that they would send, it would be, you know, send me the past 4 or 5 years of investment letters, especially the years where, you know, things got rough, like 2008 or 2020, or, you know, any given year where you had a bad investment, and really get to know their thought process through their investment letters.
Yeah.
So that's kind of like the best way that we can gain insight on their investment process, because I truly believe that the investment process of a manager is their way to achieve alpha, if they ever achieve alpha, no? So, and that's really kind of like their differentiator and their edge. And that's something that we as a family office have to try to answer, no? Does this manager have an edge or not? So, so again, I think it's just a matter of, and again, I think we do not rely, I mean, we obviously take a look at historical returns, but it has a very low weighting on our kind of like overall grade that we assign to the manager. What we are mostly concerned with is how did they manage the portfolio in a difficult position. Like one of the favorite questions I asked, and you know, to some managers it kind of you know, moves their footing a bit, is you know, you've told me about your great investments and, you know, the case studies of you know, the Amazons that you've invested in and everything, but tell me about a time when you invested in a company and it completely blew up. Like, I just want to know what your thought process was. What did you go through? Did you sell? Did you double down? Did you, you know, hedge your position in any way? And those questions, I think, are the most important ones for us to really assess whether we want to partner with these managers for, you know, decades, no? Because at the end of the day, we're in the long run play, and I think kind of like talking about the failures of managers is a great way to learn from them.
Yeah, and Rodrigo, for you know, so something that I do is that so I have a mentorship group of, it's about 6 people, and I meet with them once a month, and they're all kind of like 20 years ago or 15 years ago. And one of the things that I realized that many of them didn't have, and which is really valuable, and I kind of going to assume that there is somebody in this call who either has a fund, plans to start a fund, is somewhere, you know, would be a part of that mentorship group. And so my experience is that somebody like Rodrigo, you know, you don't want to, it's a tough question to ask. And, you know, you don't want these managers to hate your guts. So it's not an easy thing to say, listen, it's all very nice, but tell me where you failed massively. So what I did, and I don't know how many other people do it, and I'm curious to know, once I've said it, you'll tell me if you've seen it in other managers, Rodrigo, is that I wrote up in my DDQ my worst investment failures. And so I can tell everyone that writing my book was a very difficult process. And if anybody thinks writing is easy, it's not, but it's a good activity to do. Even more difficult, perhaps, than writing my book is writing that section in the due diligence questionnaire. And that due diligence questionnaire is way worse than a business school application, because in a business school application, you write 3 essays, and again, they're kind of positive. Whereas this is kind of like trying to go in depth and basically saying to Rodrigo or others, you know what, I'm going to assume, I'm not going to put you in a position where you have to ask the question and I'll answer you verbally. I'm going to assume you've asked the question and here's the answer in writing, basically. But I think that's a good thing to do. But do you see other managers do that?
Well, not really. I mean, it's very hard to find managers where they have like a written response, kind of like their failures. But what I have noticed is that when I pose a question, they kind of give it a certain twist, and they they kind of talk about, and the same, like the analogy is right. Like when you get the interview from business school, like it's a typical question as well. Like, tell me about a time when you had a failure at work or something. You kind of twist the answer a bit, kind of like appear on top and say, okay, it was a kind of small or brief mistake, but I ended up fixing it at the end. And I think it happens with managers as well, and they kind of have that response pretty well practiced. But I frankly, I remember I was doing due diligence on a long short hedge fund that invest in Chinese equities only, and I was, it was a group of us. It just was pre-COVID, and I asked him, so PM, do you mind talking about an experience you had with bad investment and what lessons did you learn? And the PM literally was quiet for like 2 minutes, like no exaggeration, 2 minutes. He just stared at the floor for 2 minutes, and he was just like thinking about it. And I think he was doing kind of like this mind exercise, and he answered a very good response. He answered about 2 specific stocks that he did terribly bad. And I really appreciated that he was open about it, and that he, shared his thought process and how he kind of resolved it. And again, I as an allocator, I'm not expecting an answer that's, that ends up, you kind of fix it at the end. The answer I'm looking for, and there's no right or wrong answer. The answer I'm looking for is kind of like just the transparency and honesty to answer it, and also that you really digested the lessons learned. Because the worst thing I think we can do as investors is to make mistakes and not digest the lessons, the right lessons from each mistake. Because we're all going to have mistakes at one point or the other. And I think if it's within your investment process to consciously assimilate those mistakes, I think we're all going to be better investors.
And something that I've just realized recently is that, I just watched on Netflix the Fire Festival. There's a documentary on the Fire Festival, and the guy who was behind it was an extremely bright guy. And you have this thing where, so Fire Festival was supposed to be a music festival taking place on an island, and it failed miserably. And in the days leading up to it, you just knew it was going to fail miserably. And the guy was so caught up in the lies that he was telling people that he didn't take any action. And by the way, another person in that regard is the woman behind Theranos. I forget her name, but what is amazing about her is that she's so smart. She's not a dummy at all. And so what's my point? My point is that there's a level on which those two people are deceiving themselves. So forget about whether they want to be honest with Rodrigo. It's like they're just, it seems that there are people in the world who forget the relationship between what they believe to be the truth and what is actually out there. And that sense of realism and a willingness to take on reality, however it shows up. And I would tell you all that, I've gotten to know Monish extraordinarily well, and he is Monish Pabrai, the Indian investor based in California. He's an extraordinarily smart guy, but in a certain sense, a quality in him that I admire even more than his extraordinary intelligence is his realism. And I've been in situations where I've confronted him with a fact or something that is true in the world, that I can show him is true in the world. And up to that point, he has set up himself up in such a way that it's not pleasant for him to see that, but he grasps it instantly. He sees it, and he voraciously takes in facts. And I think that it's, when you do psychological tests on people, you can test this. It's kind of one of the dimensions of personality, and it's almost like it's more important than intelligence, is this sense of realism. And before they can be honest with you, Rodrigo, they have to be honest themselves. So yeah, very interesting, really, really interesting. And I would just tell you all that I feel very privileged to have, thoughtful LPs is one of the best assets that one can possibly have. So I really appreciate your thoughtfulness, Rodrigo, and I'm certainly going to be engaging with you after this. I would just tell you all that simply to get to know you a little bit more, Rodrigo, has been a benefit. It's also a pleasure to talk to everyone, but it's a real pleasure to talk to you and to hear the way you think. So
it's a pleasure is mine, Guy. Really, it's great to connect.
Let me bring into the comment. Is Jose Segarra? Are you there? Jose is another one of our panelists. He is the director of asset allocation for Principal Mexico, one of the major pension funds and equity and mutual funds operators in Mexico. So I'd love to have his thoughts on. So now we understand our managers. How do we select around that? Jose, are you around?
Yes. So what's specifically the question again, Sebastian?
So how do we select so how do we allocate in this environment amongst these managers? So
okay,
how will we set ourselves up how would we set ourselves up in the current environment, in your opinion?
Yeah, so between value and growth and all of this. Yeah, so basically the way we look at it, traditional associations that have occurred within the value and growth divide could end up breaking in this new cycle, in this new regime, in which, as was already mentioned, involves a large involvement of central banks and fiscal authorities. So at some point, there is just not going to be an ability for rates to rise anymore if you do not want the whole economy to go bust, right? So at some point we would expect some kind of yield curve control, and maybe that could break what the cyclicals do in terms of materials and financials, which have always depended on this to outperform on the movement of rates, right? So yeah, in terms of what the cycle implies and what this implies, is this like permanent support from basically everybody. That's a very large change. What the Fed did also at the last year, changing its long-term objectives, and the basic reality that their assets to GDP are just below 40%, and for example, Japan has assets to GDP of around 130%. As Guy already mentioned, nobody knows what's the right measure for this. So we know that there's going to be support there, and at the same time, this issue of modern monetary policy, is on the rise, with Stephanie Kelton taking prime time all over the place, and being well received by basically everybody. So it makes sense in terms of growth. So growth, nominal growth, should be on the upside, and that, of course, bring it with it inflation, and bring it with it all kinds of commodities. And if we do get this yield curve control, we could expect some kind of dollar downside from the bounce that we have seen of this very recent uptrend that during 2021. So all this, to sum it up, I guess we would have to break value in terms of what is most rate sensitive, fundamentally rate sensitive, which is in this case banks, and the other stuff which is just sensitive to cycles themselves.
You might be interested to know, Jose, that as Rodrigo will say, I've been there are companies that will benefit a lot if inflation ever kicks in. and the banks is one of the areas where they will benefit an enormous amount. So yeah, one other thing that I would just point out is that the banks are reflating and they're printing all this money, but they actually have very little influence on, as I understand it, beyond 10 years. It's very, very hard for them to push the interest rate around. So, I mean, I guess we did see a significant rise in rates a week or two ago, and it had an impact. Companies that don't have current earnings and where you expect the earnings to come in a long way away, it did have an impact on valuations of a number of tech companies. But I don't envy your job. I feel like mine's easier. And mine's already quite difficult, I think.
Yeah, this factors that can change, like and have been the same, like for so many years. The last time that a yield curve control occurred was on the 40s. So yeah, to call that and to see what is going to happen because of that is also very, very difficult. And you already have to know or map what's your reaction going to be, and as you said, I really keep that in my mind, that you really have to focus on what is going to end up being a good investment after 10 years, and of course, this to be fighting in this value question with the tech space, basically if you see their earnings, they have an exponential trend, their cash flows, it has been that way for some years now. So basically it's very difficult for us to forecast and to know how or where the kink is gonna occur, and for that trend to be ended or to be smoothed in some kind of way. So yeah, that's a very interesting topic for me also.
But I would just come back to and it's funny because I really did learn those times. I don't go to Monterey as much, but so Humberto Lobo is one of the big roads in Garza Garcia, and there's an area called Calzada, and around there you have big houses with big walls around them, and there's some really old property owners there, and you think of them sitting on their property, and people may be getting rich in all sorts of things, but they kind of know they're going to be fine owning those properties in the very center of a really, really good area. And so I can't talk about where some of these tech companies will go, but think for a second about McDonald's. You just know that McDonald's is going to be serving some kind of food to hungry travelers in 3 or 4 decades time. And McDonald's in a certain way is a bit like those landowners in Monterey. It's like, yeah, other people are going to be getting richer, but McDonald's will still be there. And I think that those are wonderful insights. And obviously McDonald's is not cheap, but to try and find those opportunities. And so here I have for you, Jose, for everybody on this call, I have a challenge for you. So, and also a kind of an interesting question. And so I ask everybody on this call to figure out what are the assets that you can own a piece of or control that are going to put those assets in the center of things in 2 or 3 decades time. What if, because I said that on this call, in 2 or 3 decades time, the people who are here will own more of those McDonald's land in downtown Monterey or around in Garza Garcia, and that actually because we chose to spend time around each other and sort of get some better ideas in our heads, we will end up owning a little bit more of that part of the economy than parts of the economy that might come and go. So there's a little challenge for you. I should tell you that I will have to leave in a few minutes. I have a hungry family that's waiting for dinner with me, but Just a thought. I hope I expressed it clearly enough.
Yeah, you know, I think it's a very near to an impossible question, you know, thinking about 20 years from now. And I don't know if you have seen this this study by IBM about the knowledge doubling curve and how knowledge now doubles every 12 hours. And well, basically now that we have that, it's very difficult to foresee, you know, 20 years ahead. And for sure, it should be something I would expect technology. Well, I'm sure it's going to be technology related, maybe around cybersecurity stuff, you know, but it's very difficult to imagine. I don't know if it even exists yet.
Well, let me give you one that, you know, I mean, I can give you, I talked about pilot, you know, so I don't care if they stop selling petrol. They're not going to allow cities and NIMBYs, not in my backyard, are not going to allow more spurs to be built off highways. So if you own some kind of rest stop, you know, it doesn't matter if it's electric cars, if it's trucks, petrol trucks, electric trucks, you know, you can't build another highway. You only have one highway. They might widen the highway and you own the land right next to the highway. So for me, that is kind of a sure bet, if you like. I'll give you another sure bet for me is that if you own a railway, again, it's the same thing. So you need the railway to pass through vast tracts of countryside. And what, somebody's going to allow you to build a second railway track right now, or a competitor to build a second railway track right next door. They're not going to allow it to happen. So I think that those are assets. If you own a railway network, you know, if you own the network of McDonald's stores, I think there are some, and these are non-tech assets. I think that what I enjoy about it is that you don't have to be some super duper tech analyst to understand them. So I think that there are more than that, just that. So, you know, and what I'm basing myself on is this, a thought that Charlie Munger and Warren Buffett have shared at various annual meetings is that if you own the best office block, if you own the best McDonald's franchise, if you own the best gas station and the best rental apartment block in a city, you know, you're going to do really, really well. You're going to do just fine. And actually, I'll give you another example of that just for fun, because I think that, Jose, once you start looking for them, you see them more and more, you start recognizing the pattern. So this guy, Bruce Flatt from Brookfield Asset Management, what he says is he only wants to own real estate in constrained cities. So if you go to Berlin is just flat and lots of space. And you can put up new office buildings everywhere. He doesn't own anything in Berlin. Dallas, Texas, the same thing. Just lots of space everywhere. And you can go in any direction and you can build a new office building if you want to. And then you have places like Lower Manhattan, very constrained. London and the City of London, very constrained. Brookfield Asset Management is all over those kinds of real estate because he says, Lower Manhattan, you know, you have all that transportation network nexus, you have Long Island Railroad, you have so many different things that come in there, you can't recreate that. And that's where he owns real estate. So I think there are, you know, without even having to go and kind of trying to understand tech, which I think is far more difficult. So for what it's worth, Sebastian, I have to leave this fine group because otherwise my Mexican wife, and you all know what a Mexican wife is like when the husband doesn't show up for dinner.
We know.
Yes, but I completely understand, but here we're listening to you. But no, absolutely. And I think let's just wrap up then. If you know, just on my side, I haven't said it, but I'm in private equity and venture capital. We're positioning ourselves particularly in telecom infrastructure, so towers and fiber. That's one of the areas that we really, really like. Precisely, essentiality of the asset and scarcity. That's important. And good unit economics whenever we look at early stage companies. Let's just finish if you want with Eduardo, just on private equity. we are in a capital constraint. You know, Latin America is the last capital constrained region in the world. Interest rates are the only place where you're seeing high yields, and private equity, particular, with starting to look very different from at the lower mid market than some of the listed companies. Could you share your thoughts, and then let's do some let's do a close, and so that we can get Guy to his family.
Yeah, well, I think you and I discussed this question, Sebastian, before the panel, and yeah, I mean, we did see the change, for example, in Brazil, you know, with the lowering of the rates. However, we just have different structure, you know, in terms of our economy, the way the debt markets work, the penetration, but in a way, it's really the leverage of those countries. You know, you could say one country is more developed, measuring by the you know, the penetration to GDP of the different types of credit, but in any case, we still have this view about grassroots growth, right? Young economies, young demographies. We still believe that, you know, even if governments do many things, and I really like what you mentioned, Guy, about central bankers. You know, they're ecosystems, and people just figure things out. So economists figure things by themselves, and they position themselves like anybody would in a developed market. They like the same products, they want the same things. You know, everybody needs the same accommodations. So all in all, I think it's really about a structure, but over here, our economy is that you have to be very prudent on leverage. And we know what happens with leverage when it goes the other way. So we tend to compare returns with the developed markets, where sometimes even 80% of the return really came from leverage. Whereas here, most of the returns are just, you know, straight growth or direct to the bottom line. So I guess that was a bit of the nuances that we can feel from those markets, and it applies to even some listed entities. But private equity is very different to public markets, where big companies are able to get, you know, some leverage while the rest of the economy is not. So,
yeah, and it's worth saying that I have, funnily enough, I've not had much contact with private equity people in Mexico, but I had a couple of investments in Brazil with some very high quality private equity firms, and what you can do and your members can do, Eduardo, and I guess Sebastian as well, is, you know, there, first of all, to make your point in a different way, there's a far less capital sloshing around in Mexico and other developing markets, and so unlevered returns can be a lot higher. And the reason why people like me, even if we could do private equity, can't access them is that there's a whole bunch of ways in which you can reduce the risk of those unlevered returns. And you're actually, if I stop and think about it, that's probably why my personal allocation would be maybe only 25% the United States, because those opportunities are extraordinary, and I'm a little bit envious of you for that.
I think that's the first time I hear that from an investor like you, but thank you for that view.
All right. Well, Guy, thank you very much for your time. You're generous. You've been extremely generous with it. I think we came in for a value conference, and we ended up with a buffet dinner, and it's been delicious and delightful. So, well, thank you very much. I think we'll be closing up the conference now, as we are over. We have a run out of time. There will be the conference is recorded, so that it will be available for the CFA Mexico site to our members. And I'd like to thank you all, thank the panelists, and I hope you two have a delicious lunch. And
actually dinner. But just briefly, I just wanted to say thank you so much. I really, really appreciated your engagement. I appreciated the questions. You should know that, we all learn together, and it's in the process of expressing our thoughts that we learn. And so you've given me an opportunity to think through some things. I especially thank Eduardo, Jose, Rodrigo, and Sebastian, and the other questioners for being willing to engage with me. I hope that my negative comments on Mexico notwithstanding, you'll consider me as a fellow Mexican. I want you to know there's a piece of my heart that will always be Mexican, even if we don't live in Mexico. And from the bottom of my heart, I can tell you that I'm grateful that I married a Mexican. I think that, at its core, Mexico has some extraordinary values, many of which are, some of them are rooted in the Catholic Church, but some of them are rooted in the indigenous cultures. And I feel, my wife is very much an appreciator of the indigenous cultures of Mexico. And so I feel like I'm a part of that. When I went to a value conference in Santa Fe outside of Mexico City, after I'd been married a few years, I suddenly realized that the environment was no longer foreign to me. It was in some way also my environment, because I was living in a household created by a Mexican woman. So you may not feel like I'm one of you, but I feel like you're one of me. So thank you, everyone. And we'll see what my wife has prepared for dinner.
Thank you, Guy. We're really honored to spend this time with you. Thank you.
Thank you.
Sebastian and Guillermina.
Thank you, Sebastian, for organizing.
Thank you, Guy. And thank you all for coming to this very interesting conference. Thank you, Guy, for your time. It was more than we expected to have for you, and it was a very, very productive. And I only want to ask, can we share this session with all the participants that couldn't?
Of course.
Connect?
Yeah, of course. And you can share it with anyone you like. I give you permission to share it with anybody you think you should share it with. You're also welcome to share it with the general public, but you're also welcome not to share it with the general public. No problem.
Thank you. Thank you. So thank you, everyone, and have a great dinner.
Bye.
Bye. Thank you.
Great.
Thank you.
Thank you, guys. Bye. Thank you.